Good morning. My name is Jason Brown. I'm the Director of Advisor Success here at Foster Group, and I'm joined by my colleague, Kent Kramer, who's the Chief Investment Officer. We'd like to welcome you to our webinar, Making Your Own Path Through Election Year Markets. Just a few housekeeping items before we get started today is, first of all, this will be recorded and you'll be sent a link. You can either watch it again or maybe send it to somebody who you think could benefit from it. We're scheduled for 30 minutes. Hoping to do some Q&A at the end of the time. If you've got a question, there's a button to push at the bottom of the screen and you can write your question in there. And if we don't get to a question that you've asked, we'll make sure to respond later on. So Kent, we're going to be joined today actually by Dan Clifton. So it's not just going to be the two of us. You had an interview with Dan a few weeks ago. Right. Could you tell us a little bit about him and Strategas, which he works at?
Yeah, you bet. So Dan is the Director of Policy Research for a group called Strategas. Strategas is owned by R.W. Baird, and they are an investment and economic research firm, but they specialize really in looking at the political environment and how political policy may play out in kind of global economics or U.S. markets. So he's a really interesting guy. Now, something you need to know about Strategas is they've been ranked as the #1 kind of research firm by institutional investors. So they're very, very good and very accomplished at what they do. And Dan is the director of that policy research division. So when I was given a chance, we kind of asked, could we get something like this for an interview? And we had the opportunity. I was really glad because I've heard Dan speak and present a number of times. They are a thoughtful firm. They do some really in-depth research. And so we're going to be sharing some clips of my conversation with Dan around some questions that we think are really related to this idea of navigating kind of an election year market.
Where we want to start with your interview with Dan is just to make some comments on how challenging this year has been for markets. And Dan said a few things about this. One that was interesting is that he talked about the volatility we've seen historically in sort of midterm election years.
Yeah, and it's been a difficult year, probably starting last October when we saw inflation start to show up. The Fed began to raise interest rates. Of course, as interest rates went up, bond prices went down. And then we saw the U.S. equity markets and global equity markets turn down into a bear market, down over 20%. And along the way here, we've got a midterm election coming up that creates some polarization, or at least brings that polarization to the surface. All this makes for an uneasy environment for investors, I think. And so Dan is talking about this in this clip. And the thing that's interesting to me is, while this is a midterm election and we're seeing a lot of volatility that seems unique in terms of its causes, the idea that midterm elections bring about volatility maybe isn't quite as unique as we think. So let's listen to Dan talk about the history of midterm elections and the presidential cycle in general.
This is a midterm election year, and the market cycles around midterm election years are just totally fascinating to us because there's 4 years to a president's term: year 1, year 2, year 3, and year 4. We call that the presidential cycle. And what we have found is that midterm election years tend to be much more volatile for the stock market than the other 3 years in the presidential cycle. What do I mean by that? The average intra-year decline on the S&P 500 in a midterm election year is about 19%. Now, if we go and look at year 1, year 3, and year 4, the average decline is about 13%. So there's something unusual happening in the midterm election year that is different than the other 4 years.
So here's the primary thing I'm taking away from what Dan said, just me personally, is 4 years from now, I'm going to head into that year assuming we might have a very bad year at some point.
Yeah, I think the point here is when we think about this year, midterm election, we look at previous midterm elections. On average, that kind of midterm election year tends to be more volatile. Now, the interesting thing about volatility is it works both on the up and the down side. So, yeah, I don't think we should be surprised maybe 4 years from now, but I don't think we should be expecting it to be necessarily a terrible year the whole year. Because if we look back at that slide again, what Dan was talking about was post midterm elections, there tend to be some relatively above average positive returns. So we have to be careful not to make predictions and then get it wrong because we're trying to do something in the short term that maybe is more of a long-term trend, but not always the same.
So that was kind of a general observation that Dan made about what goes on in the market during midterm election years, at least historically. You also got into some of the specific reasons for why there's been kind of downward pressure on the market.
Yeah. And I like this clip from Dan because he's going to talk about kind of taking some medicine here, that maybe some of the pressure, the downward pressure on markets as a result of unwinding some of the things that we needed to do during that COVID period. Coming out of it, government took a lot of actions. The federal government, the Federal Reserve, created some environments that we might need to slow down a little bit now. In other words, take that medicine. So listen to Dan as he talks about kind of why we might be experiencing what we are right now.
Where we are today, what the market's been trying to adjust to is that you've had this Fed put in the market where they would cut interest rates if the economy got bad, or Congress would pass more fiscal policy if the economy got bad, or geopolitical risks weren't risks. All three of those frameworks have changed because now you have monetary policy, which can't cut interest rates because of inflation, fiscal policy, which can't provide checks because of budget deficits, excuse me, and geopolitical risk, which has got to be dealt with. And so we've lost a little bit of the cushion. And that's why that market decline felt so rough in the first half of this year. The key is the choices we make as policymakers will determine how quickly that recovery is. And what the Fed is saying is, we're going to take our medicine now. We're going to raise interest rates, get the excess liquidity out of the system so that we don't have to deal with inflation again and make the same mistakes we made in the 70s. The global coalition is saying we're going to defend our supporters and allies around the world and show that you can't just go push us around and try and kind of get us back to an even middle ground. And then finally, on fiscal policy, our budget deficit today is actually lower than it was right before COVID started. So again, we're taking our medicine. That's why it feels painful. But ultimately, if you do it right, then you can get the upside in the future from that.
I find it kind of hopeful when Dan explains things that way, that the pain we've been experiencing this year in the market is maybe a positive because we're choosing to take our medicine now rather than later.
Right. And I think he does view it as a positive. Now, of course, not everybody agrees as to what that best medicine is or to what degree we should be taking it. But I think the underlying message there is we're going to have to take some medicine sometime in order to get through this. And we heard this, of course, from Chairman Powell, even last week, talking about why the Federal Reserve is going to continue to have a rate raising posture until they really see inflation turn over in a significant way. Because, hey, it's no fun to have those rates go higher and for the economy to slow down, but it could be far worse if inflation really gets out of control. And the Fed's saying, we do not want that to happen on our watch.
Mm-hmm. Now, you also spent a little bit of time at least, talking with Dan about maybe what we could expect in terms of just the election itself this fall.
Yeah. Yeah. You know, if you've listened to any Foster Group presentations, any of our advisors in the past, you know that we are loath to make predictions. This is an interesting one because Dan's looking at data over the last number of decades as to, well, what we might expect for an election result in a midterm based on a couple data points. So without stealing his thunder, let's listen to Dan talk about where things might be leaning in terms of electoral results going into November.
What we find is the biggest impact on this election is the president's approval rating, because the election is a referendum on a president's first 2 years in office. And so we have a very strong correlation between the president's approval rating and the number of lost seats that goes all the way back to Dwight Eisenhower's presidency in the 1950s. Okay. And so we monitor that very closely. President Biden in the month of July recorded the lowest level of an approval rating of any president before his midterm election at just 37%. And so there's a wave building here against the Democrats. Now, I'm giving you this background because we actually are starting to see the president's numbers begin to bottom out. Some of that's a little bit backward looking. Mm-hmm. The price of oil is the most correlated to the president's approval rating. And by the way, I can do that for 50 years of presidents. Like every time they come in, I'm like, all that matters is what people are paying at the pump. And they never believed me for the first 2 years. Now they get it.
Yeah.
And so as the cost of gasoline went $5 to $4, you've actually seen voters beginning to worry about other issues that's not inflation. You're also seeing some easing of food prices, which is interesting to us.
My guess is that depending on your side of the aisle that you fall on, you're going to either appreciate or not appreciate what Dan just said.
Yeah, I think the point there is, Dan's not really coming at it, or he's trying not to come at it from a partisan point of view. He's just saying, hey, these have been the statistics that tend to indicate what might happen in the midterm election. He mentioned there that some of those statistics have changed. I was able to talk to Dan now about 2 weeks ago, and just since that time, the price of oil has continued to decline. The president's approval ratings have continued to improve. So the idea of making a prediction about an election, even 2 months out, you realize there's a lot of variables that could change regarding the outcome of the election. However, we're going to see here in a little bit, we're thinking maybe that is not the most important thing for investors to know in terms of what that election result might be and how they should position their portfolio.
Well, and that's where you went with Dan as well, is you basically said, okay, you made this prediction and it's kind of a so what question. And making a connection to our investments. So what, Dan? Let's say this side wins. Does that mean anything with regards to our own investments?
Right. Dan's got a great answer, one that should sound familiar to those of you who have heard us before. So let's listen to him talk about whether or not the stock market is partisan.
Yeah, what I'd like to say is that stock markets are not partisan. I try and tell my clients this all the time. And what you generally see is that elections, and in particular midterm elections, are very focused on sectors. Are we going to expand healthcare? Are we going to increase oil production? And they actually really do have a big impact on the sectors. Sometimes it can feed out into the macro. But if you look at how the stock market is traded across different combinations of government, you really see no difference over time between the political parties. In fact, right now, we have a Democratic president, Democratic Congress. The average return annually is about 9%, a little bit higher than 9% for that combination. We're going to have elections in November where it's likely the Republicans are going to take the House. If you have a Democratic president, Republican House, and Democratic Senate, your average return is going to be over 13%. If the Republicans win the House and the Senate and a Democratic president, your return is going to be a little bit higher, but still a little bit higher than just 13%. I'll take any of those combinations, 9%, 13% annually in the stock market. And the market just generally knows how to adjust to that. And the market also puts pressures on policymakers to get it right overall.
Ken, I had this memory growing up of my teachers turning to me when they really wanted me to grasp a point, and they would say, now repeat after me. And I sort of feel like this is something that we're sort of like, repeat after me. Stock markets are not partisan.
It was really good to hear Dan say that, because it's the research that we look at. I mean, we pull these statistics out every 2 years because there's going to be an election. And invariably, investors and voters, people just want to know, hey, is one party better than the other for the market? And I remember 2 years ago when we updated our table, which I think is on the screen now. And if you look at the bottom numbers there, those 14.52s right next to each other, they talk about one party having control of all, let's say the president's, the executive branch, the Senate, and Congress, the House of Representatives. The idea there is one party, if they have complete control, better than the other party if they had complete control? And I remember doing the math and looking at that going, they are the same number on average, going back to 1926. I checked my math a lot of times because I thought there is no way that we're within 1/100th of a percentage point as being the same, but there it is. And there's a lot of different ways and combinations that power is shared in Washington for sure. But I think the upshot of that for investors is, hey, the market is going to kind of process what the political environment is.
Right.
The political environment will set the rules, and then corporations and individuals, they want the economy to succeed. They want their personal economy to succeed. So they'll take the steps to find that success regardless of who's in power.
Yeah, so it adapts.
It adapts
to
absolutely.
whatever situation is facing it.
That's exactly right. I think, again, repeat after me. The stock market is not partisan. That's just going to be good, helpful kind of peace of mind information running into November.
And you and I were talking, Ken, this is absolutely not to say elections aren't important. Of course, they're very important for many, many reasons. But to be clear, what we are suggesting is maybe differently than what you have a tendency to hear from the news media that we consume, maybe they really don't have that much to do with our portfolio.
Yeah. And I think that's going to be very hard for people to remember, but it's really important to think about maybe a wall between how you're forming your political opinions, how you're going to vote, what policy things are important to you, all very important that we participate in that process in the United States. But remember, there's probably a wall then between that, what you're doing there, and what you're doing with your portfolio. It's not saying that they're not related or they maybe don't influence one another. It is saying the decision making that you make on your portfolio side, your financial planning side, is important, but important with a different set of variables than what's happening over here on the political side. And that's a hard thing to do because the news media will want to say in a very loud voice, as will politicians and parties, that, hey, what happens over here in the election is going to have a direct and significant result in your market portfolio. And what history would say is that is just not true. But it's going to get said, and it's going to get said a lot of times in different ways between now and November.
The last clip we're going to show from Dan is also something that I've heard you talk about before, Ken. And it's contrary to what we would hope for. The ability for us to know what's going to happen in the future is extraordinarily limited, if not impossible. But even our ability to explain in exact terms, this is why what's happening right now is happening.
Yeah, this was a great clip from Dan. He ends it very humbly, which I appreciate. One of the things that I've become really interested in over the last number of years is something called behavioral economics or behavioral finance. And a lot of that's based on the work of psychologists and people like Dan Kahneman, who is a Nobel laureate. But what they have been researching is kind of our biases, the things that we want to believe, the narratives that we have. And one of the things about that narrative idea is we have stories that we like, our narrative that we want to be true. We seek out information that confirms our narrative. There is usually information that backs up our narrative out there. So this thing is called a confirmation bias. I've got the narrative. I'm looking for confirming information. As soon as I find it, I latch onto that confirming information because I like what it says about my story. And then I feel confident enough to make continued predictions about the future. There's an overconfidence bias. That overconfidence bias that leads us to want to make predictions or to think that we should be able to make predictions about the future is the kind of thing that can really get us into trouble. What we like to say to investors is, hey, the way to think about your portfolio future is rather than trying to predict what's going to happen, let's be prepared for a variety of outcomes because there's a real possibility that if we try and predict, we might get it wrong. And this clip of Dan, he's just talking about how recently they went through a period where they got it wrong. Let's listen to Dan.
I think I could write a book about what happened in November of 2021 that we didn't see 3/4 of what was happening at that moment while it was happening. And it was the election of Republicans in Virginia and almost winning in New Jersey, which told you the Democrats were going to lose Congress, and the inflation report that came out and the COVID. And you put it all together and it was this seismic month, but nobody knew it was happening at that time. And so there's always going to be those biases.
It's good. Always going to be those biases. At the end.
Yeah.
It's important for all of us to think about how our own biases affect I can't remember who said it, but they talked about truth, Kent, being something like opinions, like we form our opinions and then we search for the facts to support those opinions.
Right. That's right. That's that beautiful confirmation bias. We form a narrative that we like, and then we go find the facts to back up our narrative.
Yeah.
Confirmation.
And I have to admit, it's a very enticing thought to think that we could predict the future. Not simply because why would that be helpful in terms of investing, but also for any number of reasons, just as a human being. If we could predict the future, there's a lot of downside in life we might be able to prevent ourselves from.
Yeah. We were thinking about this webinar and the title, we talked about making your own path in an election year market. And I think what we came away from as we thought about it and why we titled it that was because there's going to be a lot of people out there, in the media, politicians, who are going to act and talk as though they have a better plan for your portfolio and for your investment approach than you. Remember, you've put your portfolio together, preparing for a long-term plan that is unique to you. You're looking 10 to 20 years out, and that portfolio and financial plan should be constructed with all those things in mind. You're hopefully diversified so that regardless of what happens, you haven't put all those eggs into one basket. So if one prediction goes wrong, you don't find yourself unprepared for a variety of other outcomes that could be in place. We just think that's so important that when you're thinking about making your way or making your own path, that it is your path, because your portfolio, as we've seen, while elections have consequences, they don't seem to have a ton of consequences on the long-term performance of investment markets, especially today. We've been looking at the stock market, and that would seem to be the case. So, again, be involved, be engaged in the election process, but be wary of letting that engagement or your prediction about, or someone else's prediction about what they think is going to result from that election. Be wary of taking investment or financial planning actions based on a prediction of what might happen in the election.
Well, one of the things I like to give Kent the opportunity to do as we move from this portion to the Q&A portion is I sort of say, Kent, what do you want to leave us with? What's a thought you want to leave us with? And maybe you started to get into this here, but what's something that you personally would want us to leave this webinar with?
So the phrase that I like in these kind of environments is to emphasize not prediction, but preparation. So when we think about what's going to happen in the next number of months leading up to the election, or the next number of months coming out of that election, as the Federal Reserve continues to take action to try to control inflation, as we look at, kind of how do we recover from this current down market, all those kinds of things are going to be out there, and there's going to be lots of different people making predictions as to what is going to happen when. And our advice is always, rather than relying on a prediction, rely on good preparation. Part of good preparation is really being diversified. Your portfolio should have cash, bonds, and stocks, and lots of different stocks. And those stocks are the long-term generators of return. Regardless of what happens in the next 2 months, stocks are the things you want to hold for 10 and 20 years to benefit from compounding. Einstein called compounding the eighth wonder of the world. The point there is you have to hold for a long time to make sure you get the benefit of that compounding. But you want a portfolio that has other assets in it so that in the short term, cash needs you might have, market may go down for a little bit longer than anybody expected. Hey, you've got the reserves, the liquidity to hold on to that, to continue to make progress on that financial plan. So, markets aren't partisan. That's a good one to remember. Preparation over prediction. That's a good one to remember. And then if you want to have conversations about these things, I would really encourage you to have those conversations with, your advisor, with people who you trust. And be wary of, maybe you're going to talk about this, be wary of watching or consuming too much news, especially on television, because they're going to try to get your attention in ways that we think might not be helpful.
Kent, one of the things, just speaking personally, that I really appreciate about you, and unfortunately, it means you're not going to be on the news a lot, is that number one, you got a clear grasp of reality. So I appreciate you're not starry-eyed, but you are optimistic. And I think that that's very helpful when we think about investing.
Yeah, absolutely. I think the thing that I've come to believe, and I think history bears this out, is for most of us, we're going to need to be kind of short-term agnostics, meaning I don't think you can know what's going to happen in the short term, but we can be long-term optimists. Because history there would say for people who are long-term investors in the diversified portfolio, markets around the world have treated us as investors very well.
Well, one of the questions, Kent, that has come in is just related to this market volatility that we see that seems to amp up during election years, and that also seems to get increasingly more as the election approaches. Is it still a good time to invest? That seems a little bit of a scary time to be putting money actually into the market.
Yeah, great question. The way that I would answer that is if you have a portfolio that's been constructed in light of a long-term plan. So, you know how much money you need in cash, you know how much money you need in bonds, you kind of know percentage-wise what you want in stocks. If you have excess cash, investing in the stock market could be a perfectly reasonable thing to do. And here's why I say that. Volatility works two ways. We've been talking about volatility. Most people, when they talk about it negatively. They think about the downward part of volatility. But if you remember one of Dan's charts, it showed the recovery of markets after those midterm larger drawdowns, and the recoveries were larger following midterm elections than the other 3 years in the presidential cycle. So if you're thinking like that, you go, well, I don't know for sure what's going to happen in markets coming up here in the near term, but I do think, and again, think about a long-term investment like a stock, the tendency of markets is to rise over time. If I think about a stock or, make an investment in the market that I'm going to hold for 5 to 10 years, do I think prices 5 to 10 years from now will be higher than they are today? The likelihood is very strong that they will be higher, which will mean today was a reasonable buying opportunity. May not be the best one, but it will likely turn out to be a very reasonable time to make an investment in a portfolio that's based on a plan.
Great. Well, Kent, I think I'm going to wrap us up here right now. I would love to talk with you or maybe our audience at some point about the news or negative news bias. If you want to talk about that with Kent or me, feel free to contact us personally.
Short answer is try to watch less.
Yeah, that's good. So just want to remind you that this webinar has been recorded and we'll be sending you a link to it. Feel free to watch it yourself or send it on to someone else you think it might be helpful for. Want to give a special thanks to our clients who are watching right now. Thank you for allowing us to work with and serve you. And to those of you watching who are not clients of Foster Group, I want to invite you to consider becoming one. And there's a way to contact us on the screen as well. We'd love to talk with you. And then finally, we want to learn about how to do these better. And so you'll be sent a survey. We would really appreciate it if you fill those out. We try and pay attention to them. So once again, thanks so much for joining us. Hope you have a great day. Bye.